Hi teacher, good morning. Thanks for your time on watching our presentation for our assignment. So our title for our assignment is the flow of BlockFi. So my name is Li Xiangjun. This is my teammates which is Kai Hong, Edwin, Suanzi, Yichen, and Jinglun, which is going to present after it. So let's step into our introduction of the BlockFi. So we're going to talk about the background and history of BlockFi. So what is BlockFi? So okay, BlockFi is basically a cryptocurrency trading platform, and basically they established in 2017, and their founder is the Zach Prince and the Flori Marcus. So the BlockFi, their purpose is to provide high quality financial services that related to cryptocurrency, for example, like crypto-backed loan, interest-bearing accounts that highly related to cryptocurrency. But however, BlockFi encountered significant financial crisis in 2022, and there are several major factors that caused it and lead them to the bankruptcy in the end of 2022. So the major factors that caused them to bankrupt is the plummet of market value of cryptocurrency. So we know that the cryptocurrency, the significant drop of its value in 2022. So for example, like the Luna and the Terra USD, they're facing the significant reducing in the market value in 2022, and is negatively impact the BlockFi and their financial performance. And other than that, the other major reason is the significant exposure of the financial of the BlockFi to FTX and FTX subsidiary, which the Alameda. This is because FTX also experienced financial crisis in 2022. So which is in the November of 2022. So BlockFi is they wanna rescue Alameda and they issue loan to Alameda, but eventually the Alameda also bankrupt in the end of 2022. So they failed to pay the loan, so it's also like uh, exacerbate the financial crisis of the BlockFi. So after the introduction, let's my teammate to explain the in details on about the factors that causing the BlockFi and leading them to financial crisis.
Good morning, everyone. Today, we will diving into the turbulence collapse of BlockFi, a case that sent the shockwave through the cryptocurrency world. BlockFi, therefore, is the perfect storm of liquidity risk, credit risk, and systematic vulnerabilities. To understand how this promising platform crumbled, let's explore the core challenge it faced and the factors that contribute to its collapse. First, let's discuss the liquidity risk. Imagine running a business with 1.2 billion tied to a key partner, and overnight the partner filed for bankruptcy. This was a rarity for BlockFi when FTS and Alameda Research imploded in November 2022. BlockFi had significant exposures to this entity, relying heavily on FTS native token (FTT) as collateral for luggage loan. When FTS collapsed, over 1.2 billion for BlockFi asset was frozen. To make matters worse, panicked customers began withdrawing their funds, creating a liquidity crisis that BlockFi could not withstand. Although BlockFi had significant policies to manage liquidity, such as maintaining 10% of customer funds as reserve and ensuring 50% of debt could be recovered quickly, the collapse of external partners like FTS, Alameda, and even Terra stablecoin renders this measure ineffective. BlockFi relied on unstable asset and unsecured loan, left it vulnerable to the crypto market volatility, ultimately forcing the company to file for bankruptcy. Now, we'll look at the credit risk, which compound BlockFi problem. Two of the largest borrowers of BlockFi, which is Alameda Research and 3L Company, we can call it 3AC, defaults on loan totaling over 1 billion. BlockFi lent 900 million to Alameda, mostly backed by FTT token. When FTS collapsed, the value of this token plummeted to near zero. Besides, 3AC owned BlockFi nearly 220 million, but when bankrupt, leaving BlockFi unstable to recover its funds. This massive loan default, combined with BlockFi over-reliance of volatile borrower, undermined its financial stabilities. It's like lending your safety net to someone only to find it's completely when you need it the most. With an inability to recover its asset and process withdrawal, BlockFi failure was sales.
Now I'll continue to talk about the crisis of BlockFi. The first one is systemic risk. And what is a systemic risk? Systemic risk is like a domino effect. When one major player in this industry collapses, others also follow. And in the crypto world, this interconnectedness is extreme. Let's rewind to the crypto winter. And this wasn't just a cold spell, it was a massive downturn in the cryptocurrency market. Investor confidence plummeted after the collapse of major players like Terra Luna, and to make things worse, Bitcoin's price dropped a staggering 63% in 2022. Now, why did this matter so much to BlockFi? While BlockFi's middle business model heavily relied on high-yield lending backed by cryptocurrency as collateral. Sounds profitable, but it is not when the market crashes and those crypto assets lost value. Suddenly, that high-yield model became unsustainable. And here's where things went from bad to worse. BlockFi relied heavily on companies like FTX and Alameda Research to provide credit. When FTX and Alameda collapsed, it was game over. BlockFi couldn't collect their loans and leading to their own bankruptcy. This is the perfect example of systemic risk, a domino effect that rippled across the entire cryptocurrency ecosystem, causing multiple companies to fall. And once the first domino fell, there was no stopping it. Now, systemic risks were not the only problem. BlockFi also faced idiosyncratic risks. The risks are unique to their own decisions and operations. And unfortunately, they made some serious mistakes. Let's start with their ineffective risk management. BlockFi's internal teams actually warned their leadership about the dangers of lending large amounts to Alameda Research and relying on the volatile FTT tokens as collateral. But instead of listening, BlockFi doubled down on those risky loans. Between July and September 2022, Alameda borrowed nearly $900 million from BlockFi, backed up by unstable assets. So when the market crashed, BlockFi was left completely exposed. And mistake number two was over-reliance on a single revenue stream. BlockFi's primary source of income was high-yield cryptocurrency loans, and while that's great when the market is booming, it's a disaster when the market turns bearish. They didn't diversify their income streams, which left them extremely vulnerable when borrowers began to default their payments. It's like putting all your eggs in one basket and then dropping the basket. And if that was not enough, BlockFi also faced major regulatory challenges. In early 2022, they were fined $100 million by the US Securities and Exchange Commission, or it's called SEC, for offering unregistered securities through their BlockFi interest accounts, or BIAs. This wasn't a small fine. It accounted for nearly half of their reported equity funding of $450 million. And that fine didn't just hurt their finances, it shattered investor confidence. After all, who wants to invest in a company that's under regulatory scrutiny? On top of that, BlockFi failed to register their BIA as part of their securities, and they didn't register as an investment company. This mismanagement not only resulted in financial penalties, but also raised serious questions about their compliance and governance. In the highly regulated financial world, especially when dealing with digital assets, failing to follow the rules isn't just risky, it's deadly. So, what can we learn from BlockFi's downfall? The first one is systemic risk. That reminds us that no company exists in isolation. The collapse of one major player can trigger a chain reaction across the entire industry. The second one is idiosyncratic risk, shows us the importance of good decision making. Ignoring internal warnings and over relying on one revenue streams can be fatal. And finally, regulatory compliance isn't optional, it is essential for survival.
Hi, my name is Evan Fong, and I'm going to be talking about the leadership team in addressing the crisis. Let's start off with the stakeholder communication. So initially, BlockFi stated their commitment to transparency, reassuring the stakeholders with transparency and integrity. Regular news updates were communicated through press releases, email updates, legal filings, company website, and social media like Twitter, which is formerly known as X. Despite all these frequent communications, stakeholders still criticized the lack of detailed disclosure which was provided by the company. Even to the extent where Zach Prince, the CEO of BlockFi, was accused of fraud and dishonesty. All this lack of detailed disclosure of the financial information caused the creditors, investors, and customers to lose trust in this company. Let's move on to the actions and decisions made by the management during the crisis. BlockFi filed for Chapter 11 bankruptcy protection in late 2022, citing the need for stabilize operations and explore restructuring options. This decision aimed to preserve the remaining assets and provide a framework for addressing the creditor claims. The move was a necessary response to the significant liquidity issues which was discussed before, but also signaled the depth of the financial crisis that this company is in. Secondly, the asset recovery efforts. The leadership initiated a legal proceeding to recover the assets that was tied to FTX and Alameda. These efforts included pursuing claims in FTX's bankruptcy proceedings to retrieve the collateral that was held in FTX during the failed exchange. So thirdly, customer withdrawals. A pause on customer withdrawals was implemented to prevent a bank run. BlockFi had denied all the rumors claiming that most of its assets were tied up in FTX, but it confirmed that it has significant exposure to FTX. So due to this exposure, BlockFi had to pause the withdrawals and advise customers not to make any deposits. So this move actually influenced many of the customers to worry as their money was stuck inside the company. Next decision made by the company was their strategic planning. So they had 3 strategic planning, which was to try reduce the expenses and seek investment, and they also implemented a restructured payback plan. So for reduced expenses, they actually lay off customers, lay off their workers, and also try to reduce their operation capacity. So nextly is increment of salaries. Now this is where it gets weird. So this company is under a crisis, but they still made a retention strategy to increase their top management salaries up to 50%. They said that this was due to a loss of equity by the during the crisis, the loss of equity of the top management. So they need to increase their salary to make them stay and operate inside the company. This was a very sketchy move, as many of the customers were like, what is happening? Why are they increasing salaries when they are in a crisis? Let's move on to the evaluation of the leadership of BlockFi. So there are strengths and weaknesses of the management leadership. Let's start off with the strength. So the leadership team acted swiftly to address immediate threats, such as filing for bankruptcy under Chapter 11 and pursuing asset recovery. Transparent acknowledgement of the crisis and also consistent communication to get back their asset recovery is a good sign and a good effective leadership. Let's move on to the weaknesses of this leadership. So delayed clarity on key details and the inability to secure new funding undermines stakeholders' confidence. Also, strategic decisions such as halting customers' withdrawals and increasing salaries were reactive rather than preventive. Imagine you are working in a company and the company was going to go bankrupt. While not giving you salaries, they increase their top management's salaries to continue the operation of the company. It doesn't make sense, as you don't get your money, but other people in the company which caused the crisis get the money. So this is the main issue of this part, and yeah, that's all from me. Thank you.
Hello everyone, I'm Michan, and I'll be presenting the recommendations that BlockFi could have taken to prevent the fall of their company. Let's move into the first block of information, which is enhanced diversification and risk management of loans. As we know, BlockFi had heavily relied on FTT tokens, which are FTX's own cryptocurrency. With that said, they were also overexposed towards companies like FTX and Alameda Research. This led them to harbor very, very high risks. So, when FTX and Alameda Research collapsed, it led to a domino effect, which also heavily affected BlockFi. The first recommendation would be diversification. So, BlockFi could have diversified its portfolios and collateral strategies, reducing its exposure and dependency towards a single partner or cryptocurrency. By diversifying its portfolios, the failure of a single company won't have a profound effect on BlockFi itself. So it can draw upon assets and loans from different companies that they had invested in. Secondly, it would be risk management. They could have deployed more effective analytical tools to predict market trends and monitor risks. This would allow them to preemptively adapt their strategies to any risk. So this could be in the form of reducing their exposure towards any kind of investments that they have their assets in, let's say different kind of cryptocurrencies, or predicting market trends to ensure that they have enough liquid reserves to pay out to investors, let's say if there were a market downturn. Third would be liquidity. As we know, BlockFi had heavily relied on FTT tokens, which are FTX's own cryptocurrency. So when FTX collapsed, the value of FTT tokens also tanked. This caused BlockFi to be left with large amount of worthless cryptocurrencies. Instead, they could have invested in more liquid assets or more stable assets in terms of like commodities like gold or silver. So in case of any emergency where they had to like quickly liquidate their assets, they could rely on those gold and silver reserves. So we move on to the fourth point, enhance liquidity buffers. Now this point goes hand in hand with our previous point, which is liquidity. BlockFi should have mandated a higher liquid reserve. Now this protects the company against any unforeseen surges in withdrawals. However, in the case of BlockFi, the company did not have sufficient liquid reserves and could not liquidate its assets to pay off its investors. This led to the failure of the company as well. So we move on to the fifth one, which is emergency liquidity lines. So now, what is emergency liquidity lines? They are pre-arranged arrangements with financial institutions, preferably stable ones, that provide quick access to funds during time of crisis. So these arrangements can act as a safety net, ensuring that BlockFi can meet withdrawal demands or during times of crisis. Now let's move on to the second block of information, which is corporate governance reforms. Based on reports, as we know, before the collapse of BlockFi, there were a lot of internal warnings, namely those brought up by the company's analysts, expressing their worries regarding the looming risks associated with the large amount of loans from our research, along with the company's heavy reliance on FTT tokens as collateral. Now, with that said, the company's senior management decided not to heed the advice of their company's analysts, and instead they doubled down on their initial strategy. Now, this highlights the company's corporate governance failures, which led to the inevitable fall of the company. Now, let us move on to the first point, which is establishing an oversight board. Now, with that said, BlockFi did not have a dedicated independent oversight board initially. So, by establishing an oversight board to include external experts, it can provide the company with valuable unbiased advice on its financial decisions, which, as we know, were not very wise. Besides that, the external board members can also provide advice on the corporate governance structure of BlockFi, allowing the operations of the company to be smoothened out. Now, let's move on to the second point, which is also my last point, implementing effective and protective whistleblowing procedures. Okay, as I mentioned at the start, there were already a lot of internal warnings brought up by the employees of the company regarding the imminent risks faced by BlockFi. However, their calls, of course, went largely unheard. So let's say a more robust whistleblowing procedure was in place, their warnings could have been heeded and more effectively communicated up the chain of command, allowing the senior management to have more information to tune their strategic planning and change the direction of the company. Right. Besides that, whistleblowing procedure is also crucial element for encouraging employees to voice out their concerns regarding any risks that they believe the company is facing without the fear of reprimand. Because if those protections aren't in place, most employees would be scared to voice out their concerns for the fear of retaliation, of course. Right, I think that's about it, and thank you for your time.
Hi, I'm Tai Hong, and I will be conducting this presentation by summarizing the key points and providing recommendations. And so, BlockFi collapse has been driven by its inherent weaknesses in its business model and further deteriorating by its financial performance. So, the first inherent weaknesses in business models is they have high yield lending model, as BlockFi rely heavily on crypto-backed loans to institutional borrowers. So this reliance become very problematic, I can say, as shown by its 1.2 billion exposures to FTX and Alameda Research and collateralized by those FTT tokens. Yeah. So the second weaknesses of its business model is they are high leverage and short-term debt reliance. So the company dependent very high on a 40 million credit line from FTX, even it's exposed to unstable short-term debt. So many of these loans were tied heavily by those highly volatile crypto assets. So the third weaknesses in its business model is their over reliance on a single revenue stream. Yeah. So BlockFi focus on high yield crypto loans as mentioned. So there has little diversification So it means that their business was very vulnerable to crypto market downturns. So the lack of alternative income streams will amplify larger this risk. So BlockFi collapse has also highlighted its leadership failures. First, they have poor risk management. First, they have uh, BlockFi leadership ignore internal warnings about overexposures to Alameda Research and FTT tokens. So despite the declining market condition, BlockFi continue lending around 900 millions to Alameda. So this show their poor risk management. So the second leadership failures they have is they have lack of financial partners diversification. Also, BlockFi's heavy reliance on FTX and Alameda for liquidity, and this created a systemic risk. So the absence of diversified partnership limited its ability to withstand external shocks. And the third leadership failures is governance lapses. So the company lacks an independent oversight boards and an effective whistleblowing mechanism. So this governance lapse has caused them has a regular failures led to a 100 millions SCE fine for offering unregistered securities. Yeah. And BlockFi collapse served a lesson for SCE crypto regulations. SCE crypto SCE SCE should first establish a regulatory frameworks. The SCE must create a clear and enforceable guidelines tailored to the crypto leading industry. So this framework should enhance market stability and accountability. So second, as the SCE should implement financial management practices. So similar to traditional finance, crypto funds should conduct regular stress testing, comprehensive risk management, and transparent reporting. So this will reduce exposure to volatile markets. So this step will serve to limit systemic risk, safeguard investors, and maintain the crypto sector's long-term growth. And so Bitcoin just a few days ago reached an all-time high of $100,000. Yeah, this is a milestone that highlights crypto markets' remarkable growth, maturities, and increasing their global appeal. Yeah. However, this Bitcoin milestone of $100,000 is not just a celebration, but more likely to be a wake-up call. The potential for growth in the crypto market is immense, but there are tons of risks. To secure the future of this industry, we must learn from rulers like BlockFi and implement systems that foster trust, stability, resilience. And only then we can fully realize the promise of cryptocurrency as a transformative financial tools. Yeah, that's all for me. Thank you.
That's all from us, Group 61. We hope we provided a better understanding about the collapse of BlockFi. Thank you.